for those joining us. We'll do a quick intro on Thunder, then we'll introduce Tactic, and we'll kind of dive into the content. And then at any point in time, you're welcome to ask any questions. If you want, you can just do the little raise hand feature. You can just chat it in the chat below. I'll be moderating, but you're welcome to turn off your cameras if you don't want to be on camera as Anubhav talks and kind of goes through the material. But we'll go ahead and kick things off. So appreciate everyone joining us, and we might have some more people coming in as we go. But for some background, my name is Jason Kirby. I'm the managing director and founder of Thunder.vc. We're a proprietary network of VCs, founders, and LPs, and we use AI to identify who has a higher probability of investing in who. So we help founders identify who they should focus their efforts on, and we help VCs source new deal flow. So that's a little bit about us. And Anubhav, if you want to give a quick intro on yourself and Tactic.
So I'm Anubhav Srivastava. I'm the founder and CEO of Tactic. If for those who may not be aware, Tactic is a forecasting and planning software for VCs. We're the first of its kind. We're trying to replace all that messy spreadsheet ecosystem that exists at VC funds. Most other sectors, have software for forecasting and planning, but for some reason VCs don't. And so we're the first ones building that out. Portfolio construction is obviously the most visible piece of what we do, but there's a lot of other things as well. On this call today, we're going to talk mostly about portfolio construction, why that is important, how to do it right, things we've seen in the market. Just disclaimer, nothing on this call is investment advice. I'm going to be sharing with you a lot of opinions, a lot of actual data points that I'm hearing from my clients. Again, we work with about 200 funds globally. And so there's going to be a lot of just stuff we've picked up, either talking to GPs or hearing what LPs are telling GPs. And we're going to be sharing a lot of that here with you. Cool, Jason.
Awesome.
Should we dive in?
Yeah, let's go ahead and dive in. I'm answering emails for people that are having trouble finding the link, so get them in here hopefully pretty quick. But
Cool.
Yeah, go ahead and take it away.
So the first thing about this whole portfolio construction is this can get pretty dry, and I don't want to sound like a professor. So make this interactive. Ask me questions. Something you want me to stop and double click into, just tell me. It'll make this go a lot more faster as well. First misnomer about portfolio construction that I want to address is that most emerging fund managers sort of view it as a necessary evil, like we got to do this to raise our fund because we have to show this to LPs. The reality is an effective construction model is not just a one-off Excel spreadsheet that you send to LPs and then you throw away after the fund is launched. It's actually meant to be a constant workflow. It's meant to be a workflow that can actually help guide your actual fund performance post-raise. We'll show you what we mean by that workflow exactly and how to implement that in your fund. So first things first, portfolio construction. The reason this is sometimes so complicated, obviously, is you're balancing like 30 different variables to try and come up and land on a dime. And sometimes you change one of those variables slightly and the entire model breaks. So by that, I mean, it's very clear. It's very important to have a very clear understanding of what's an input into your model and what's an output. And we see a lot of points of confusion here sometimes. So in our opinion, this should be an input in your portfolio construction model. The size of your fund, number of deals you expect to do, which, by the way, should be determined by your team, the level of diligence you're putting into each company, target ownership, and I mean ownership, not check sizes. A lot of funds try to think in terms of check sizes, but ownership is a better metric because you can then change that based on, you can have ownership be the same, but then the check sizes could change if the round sizes and valuations have moved. So it allows you to be a bit more nimble in your market dynamic. Actual market data. So what you're a Web3 or a crypto investor, or you're, let's say, a SaaS investor. Your model, the internal valuations assumed for deals should be driven by median round sizes, median valuations that you're seeing in SaaS, that you're seeing in crypto. That's the kind of stuff that that sort of separates really great construction models from just sort of generic models. And of course, your carry and your recycling and all of the other fun stuff. The outputs should be your performance metrics, the power law curve, which is how many companies out of my portfolio am I expecting to fail, or am I expecting to return 20x? And then reserve ratio. And this is probably the most controversial one. There's a lot of Excel models floating around where you enter the reserve ratio for a deal and you then set, okay, what my expected returns should be. not going to say that's wrong or right, but I will say that there's drawback to that approach. If you're raising a fund and you're saying I want a 40% reserve ratio, embedded in that number are a lot of very implicit assumptions. For example, you are assuming how many companies are going to graduate. You're assuming how many companies I will follow on into. You're assuming check sizes on those companies. And so there's a lot of embedded assumptions within just putting a big 40% number there. And what we prefer folks do is have a more granular build up to that. So what do you want your target ownership to be? What do you want the future check sizes to look like? How many graduations do you think you're going to have? And let that drive what the reserve ratio looks like. It builds a much more defensible plan, and it allows you to defend your reserve ratio in front of LPs as well. So just very high level things we've seen in the market. First of all, please don't try and reinvent the wheel. Portfolio construction is a solved problem. And I've talked to GPs that want to try and build that in their spreadsheet from the ground up. It's just not a great use of your time. You, the GP, has much more important things to be doing instead of building a spreadsheet model from scratch. Whether you're using Tactic or you're using someone else's spreadsheet, the tool doesn't quite matter, but just try and use something that already exists. Second thing, your fundraise, if you're raising a fund, is not going to be, should not fail or succeed because of your portfolio construction plan. It's one piece that's part of a larger puzzle. At the end of the day, an LP is going to invest in you not because of a great spreadsheet model, but because of the edge that you bring, a unique market thesis or a proprietary access to deal flow. And the best models are the ones where you are able to reflect that unique edge into that model. So to give you an example, let's say you're a manager that has a unique thesis on one specific sector. Well, in your model, the valuations that you're assuming for round sizes or for graduation rates, those should reflect your thesis. And that's how you customize a model for your specific edge. So rule number one, we try and say is try and solve for this number first. If you are a small fund and you're looking to raise your first fund, try and solve for the initial investment first. Forget about everything else. You want to have about 35 to 40 investments. And I'll explain why that is. It's we talk to funds that have at times build portfolios of 15 to 18 investments, and they're a seed stage fund, or at least a pre-seed stage fund. That just doesn't work because of the power law curve. At the end of the day, we are all subject to that power law curve, and that means only a very small trickle of your investments are going to yield a 20x or a 30x. When you start to get to a 35 to a 40 portfolio size, then that trickle means one deal or two deals. If you're building a portfolio of 15 to 18 or 20 deals, then you may not have enough shots on goal to get that 20x or 30x on a single deal. This is what LPs are used to as well. LPs are used to seeing these basket of funds that fit specific profiles. And when they look at a seed stage, early stage fund, that's what they want to see, like at least a 35 to 40 company portfolio. In fact, I would say most people overthink the reserve side of things. Again, for the reserves, let the chips fall where they may. You just concentrate on getting enough shots on goal and maintain a target ownership, and let the reserve ratio be what it is. So I just spoke about this a little bit in terms of reserve ratios. We'll show this to you in Tactic, but what's really important about reserve ratio is that you want to be able to defend that in terms of what that means for the number of graduations. We speak with a lot of funds that say, okay, I have a $50 million fund with a 40% reserve ratio. I want to land at a 3x TVPI. And sometimes those are not possible in your sector. If there's just not enough graduations happening, you may not have enough opportunities to put that reserve capital into play. So just remember what you're implying in terms of how many companies are going to move on round from round to support that reserve ratio. Here's what we see in the market. This is actual data. So for a smaller fund, the median reserve ratio is about 48%. Now, this is across all sectors, so this can vary a lot by sector. On the low end, it's about 34%, high end 60%. If you end up building a fund model that falls outside these ranges, just remember you're going to have to defend that because LPs are not used to seeing this. So try and at least fit into one of these buckets. And by the way, all this is saying is some of these companies are lead investors, like this upper quartile are lead investors, while the other quartiles here are non-lead investors. That's all the difference is. Recycling is a very complicated and sometimes misunderstood term. Most construction models we see, people try and catch up on the leakage from fees and expenses by trying to recycle the exact amount of their fees. 80% of funds in the world do not end up meeting that recycling threshold. That's just the reality of it. Because at the end of the day, recycling is not a function of how much you want to recycle, but how much you can recycle, which is dependent on how often your exits are occurring, when they're occurring, and over what time period. So are you having enough exits in your investment horizon for you to even have the opportunity to put those exits into play, into reinvestments? In Tactic, we do this right off the bat, so we don't assume you're going to automatically recycle. It's actually based on much more timing assumptions. And I would encourage you to have a much more realistic view on what actually recycling is going to be based on your timing assumptions. The last thing I'll point out on this is it's easy to do this, but a lot of construction models are just one portfolio. So they're saying, okay, we want a 30 company portfolio. Here's my 30 companies. 2% of them are going to be 30x, 5% of them are going to be 5x, and then the rest of them are going to be 1x. That's not portfolio construction. That's just you building one static view of the world. A real portfolio construction plan should be much more dynamic and should be much more flexible than that. So here's how we do this at Tactic. In Tactic, we will calculate for you what your reserve ratios, number of deals, and your expected return looks like. The way this works is when you log in for the Tactic, we will ask you questions, just kind of like TurboTax, to help build your strategy and your structure. So for example, we will ask you for how big your fund is, what your GP commitment might look like. Is it an evergreen fund or is it a 10-year fund? And by the way, those things can have massive impacts on returns. Secondly, we ask you to consider what sector you're investing in and what do you think the round sizes valuations look like for that sector. Now, in Tactic, we're going to automatically pipe this data in. We get this data from Carta, Crunchbase, PitchBook. These are median round sizes, median valuations that you can set. Of course, if you're investing in a different sector, because right now this is sector agnostic, you can come in and override these assumptions. And you can even build multiple profiles. You can have like a custom fintech profile if you want, and you can set your own round size assumptions for that. The biggest thing that you should know in Tactic is that everything is about graduation rates and exit rates. So we want you to think in terms of graduations, not in terms of reserve ratios. So how many companies are you expecting to graduate from one round to the next? If you're a second fund, a third fund, or a fourth-time fund manager, you might have this data from your past vintages. And that's what I would encourage you to use. Graduation rate is not just a market-specific variable, it's a GP-specific variable. This depends on your diligence thresholds, on your decision-making ability. How great of a stock picker are you? All of that should drive into what your graduation rates are. And then exit rate is how many companies might sell themselves at a particular stage. So you define a sector first, and then you define your strategy, which we call allocations. So this is where you come in and say, all right, this is a $50 million fund. I'm going to be doing 3 types of deals: pre-seed, seed, and Series A. For my pre-seed investments, I'd like to put 40% of my capital towards those deals. I would like my initial check size to be based on a 7.5% target ownership. Now, if you really disagree with me and you want to do this on check sizes, you also can. You could literally just say, well, I would like to invest $500K in my initial round. And in that case, we'll calculate for you what the entry ownership is. But the important thing is you can set up what your initial check size is. And then the same thing for follow-on strategy. You set up how often or what your threshold for ownership should be in the follow-on rounds. And then how often do you want to follow on? This can get a little complicated, so I'm going to slow down a little bit here. What the system is telling you is with a $500K investment, you're going to be able to do about 13 to 14 entry deals. With the 80% graduation from pre-seed to seed, about 11 deals are going to make it to seed round. How many do you want to follow on into? So if this is set to 100%, you're going to follow on into all 11 deals. If this is set up to 50%, now that ratio is going to be half. So you're going to follow into half those deals. So again, this depends on your internal fund thesis on how you want to set that up. The idea is to build up these different tracks of investments that you expect the fund to be doing, and we will calculate for you how many investments you're going to end up doing in each of these categories. You can obviously set up your funds management fee structure, recycling. Just a note on recycling, and just for Jason as well, I have a whole thing on recycling and why people get confused between management fee recycling and exit recycling. So if anyone here wants to learn more about that, I can clarify that a little bit. It's a very commonly misunderstood term. But if your LPA does have recycling, you can set that up here. How much do you want to recycle? How far do you want to recycle? And then the waterfall, where you can set up your carry structure and hurdle rates and things like that. That's it. Once you go through the process, the system builds for you a construction plan, and it calculates for you how many, what your reserve ratio is going to look like, how many deals you're going to be able to do, how you're going to deploy that capital across different rounds of your investments, how many deals can you do, pacing analysis, expected capital call schedules. We also project out for you over time what the DPI, TVPI, RVPIs look like, what the cash flows look like for your GPs, for your LPs. And then the biggest question that I think a lot of LPs are asking in this market is, what is your power law curve? How many deals are you expecting to be failing in? What does that look like for your fund? And so we calculate that for you. There's a distribution of exit multiples chart that shows what the power law curve for your fund looks like. The way to read this is to say, okay, 12% of my deals, I'm expecting to be more than 20x, but the majority of them, 72x %, are going to be failures. In terms of number of deals, this says about 4 deals is what I'm expecting to get most of my capital back on. So that's what construction looks like. I just want to pause and see any questions, anything you want me to kind of double click on here.
So anyone's welcome to ask questions, but I have a couple. If you want to just either use the raise hand feature or use the chat feature, you're welcome to do so. But I have a couple questions to kind of prompt you on. When you kind of talk about reserve ratios, you kind of made a couple comments about that not being done properly and how to set that up. Like, what are some other common mistakes that VCs make when trying to project their reserve ratios?
Yeah. So the biggest mistake is that, again, people are just going top down. They're saying I want a 40% reserve ratio, but sometimes you may not have the ability to have a 40% reserve ratio if you don't have enough graduation. So that's just the most common mistake. The other one is a 40% reserve ratio will say, well, what does that mean in terms of how many follow-on deals I can do? Can I do all of them? And that math is not always, it's sometimes lost when you just put a number of 40%. Another thing is to try and say, I'm going to follow on all the time. Most funds try and build that in their construction plan. The follow-on participation rate is way too high. In reality, you may not end up following on into every participation. And so that additional filter needs to be put in somewhere. By that, I mean what I just showed you, which is you're going to get some graduations, but you're not going to follow on into every single graduation. I mean, if that is your fund strategy, that's a fund strategy, but I would say you should do that. In terms of actually analyzing reserves on a deal-by-deal basis, there's a whole school of thought on that, but the way we do it in Tactic is every reserve dollar needs to be analyzed on an opportunity cost basis. Is that dollar best spent on that next investment in the company, or is it better spent on another deal, a new investment, or another follow-on reserve? That's a very complicated calculus of variables. We do that in here, but that's how reserves should be thought about in terms of opportunity cost, as opposed to just sort of a blanket statement.
Gotcha. And then in Tactic itself, like for emerging fund manager, or maybe like someone that wants to be a fund manager at some point, like how many different scenarios could they possibly play out, in Tactic, and how, I guess what output should they be trying to pay attention to when maybe running different scenarios with all the different variables that exist?
So I'm going to answer this from an LP standpoint, because these are the questions I hear LPs asking GPs. So the first one is, like, as I said, what is the power law curve for your fund look like? Why do you believe that to be true? Is that representative of your market? If not, then why are you deviating from it? So to be able to defend those answers really well. The second one is, like, what are you assuming in terms of your exits? Is it based on standard market valuations? And if so, how many exits are you having in each of the rounds? What the proceeds from that look like? On average, what multiples are you going to be getting on your exits by round? So these are the sort of the basic questions we get asked. The other one is just kind of, as you said, running different scenarios. So in Tactic, you don't have to just have one fund model. We have a tool called Scenario Builder, where you can actually create multiple versions of your fund model. So you can have, well, what if I'm going to create a new strategy, and in this strategy, I'm going to revisit my model parameters, and maybe for my seed investments, instead of a 5% ownership at entry, I actually want a 7.5% for my seed as well. And we will run that scenario for you. We will show you what that looks like. You can save this as a new scenario, and we'll basically show you what that return profile looks like. You can create up to 10 different scenarios for each of your investments.
Wow. Okay, that's extremely convenient. So you can be, maybe not fully launched with your fund, or maybe you're considering a new fund structure for fund 2, fund 3, and you can come in here and basically play with all the numbers in a much more simpler experience than versus like trying to do it in 20 different Excel files.
Exactly.
Yeah.
Okay. Yeah. Cool. So the next thing that we should talk about, I want to show you what I meant when I said at the start that that portfolio construction is not a model, it's a workflow. So this is what I mean by that. You're going to build a construction plan for your fund. You're going to raise your fund, and you'll deploy capital. Here's what some of the more successful managers we work with do. They go back and they update that original construction plan and replace some of the investments with their actual deals and expected performance of the deals. The remaining capital that is not yet to be invested is assumed to be following the same check sizes as you said in construction. And then they see what that looks like. They see, okay, well, what does that mean in terms of the current forecast of our fund? Then they try and see, okay, what does that mean in terms of, are we on track? Have valuations moved? Have check sizes moved? Should we change our strategy? That gives them that feedback loop that allows them to go back and update their original construction strategy. So I'm going to show this to you in action. This is an active fund. I have a construction forecast that said I'm going to do about 2.33 on this TVPI, and I'm going to do 64 deals. I have now added actual investments into this. So you can actually build your real portfolio. And for every single investment, by the way, you can model out individual rounds. You can build a forecast for the deal. You can build like base cases, downside cases, upside cases for your investments. So once you add your actual investments, the tool is saying that you have deployed, out of this $150 million, you've deployed about $42 million of capital already. There's $77 million of capital remaining. I'm going to assume this $77 million is going to be deployed as per your construction strategy. I'm going to put the two together. So your actual deals and the expected performance of that and your remaining capital, we're going to marry them together to come up with where we think your fund is going. And what you can tell is that the number of deals has gone down. So my construction forecast was 64 deals. My current forecast is only 57 deals. So why is that? And the reason is I'm probably over investing in those 16 deals. I've done more than I said I was going to do. So what we try and show you under insights is a chart like this that shows you by initial check, here's what you said you were going to do in construction. Here's what you're actually doing. Or your reserves. Here's what you said you were going to reserve per deal. Here's what you're actually reserving. Are you on track or not? The same thing applies to market dynamics as well. So like your valuations. What did you believe an average Series A valuation was going to be and what it actually has been? So it's been higher. So how should you change your strategy going forward? What can you do going forward to kind of get back on track? And that's where the scenario builder becomes useful again. So now in the scenario builder, you can build a brand new scenario that is not going to change the performance of your 16 deals I've done, but will only change the performance of what you haven't done yet. So in your future investments, if you want to go in and say, well, for my future seed rounds, a future seed in investments is instead of a 1 million, I want to invest 1.5 million. Again, what is that scenario going to look like in terms of my expected returns? This is extremely powerful because what we've done is we're saying my 16 deals, I've modeled them out. I'm now taking a look at what that market looks like compared to what I thought it was going to be. And in response to that, I'm going to go back and change my future strategy. So that's the feedback loop in action. And we'll try and show you how to get back on track. So the current fund was looking to return about 3.59. With that one little change I just did, here's what I need to believe to slightly increase my TVPI going forward. This stuff is difficult to do in Excel. Because in Excel, that means you have one model that's construction, you have another model that's a current forecast, you have actual asset level models, linking them all up. This becomes kind of a mess. And so that's why Tactic exists, to try and help you with that workflow.
No, it's very clear how easy it is to kind of see what what changes you make to your portfolio impact the forecast, the potential returns.
Right.
kind of a question like, so it's one thing to kind of present your overall strategy to VC, to LPs before you go out to raise or while you're raising, but kind of like at the point where you're at this stage where you've already deployed some capital, you see that your forecasts are changing from what you originally planned. Like, how do you recommend GPs kind of present this information and keep your LPs in the loop? What do you typically recommend in that communication part?
Yeah, great question. So I'll tell you what the answer was 6 months ago and what the answer is now, because I think the market has changed and LPs are also changing what they're asking. And this also changes based on how big your fund is if you're an emerging manager versus an established manager. Usually, internal reviews and external reviews. Internal reviews are everything you see here, and internal reviews also incorporate a forecast. So they incorporate for you what you believe your reserves look like, or your entire portfolio. Where have I invested? What do my reserves look like? What do my current valuations look like? How much reserves do I have remaining for each of these deals? Just doing that planning exercise. So that's what is important for an internal analysis. And of course, there's a lot of portfolio composition data. So by geography, how much have I invested to date? Show me the answer. So there's your answer right there. Or by geography, how much reserves have I deployed to date? See that answer. These are all analysis that should be part of that internal portfolio review, by sector, by geography, by partner. What goes out to LPs is a sanitized version of this. So what goes out to LPs is usually no forecasting. We don't want to sign ourselves up for something we don't know if it's going to occur. So it's all backward-looking stuff, but it's still things like this. It's like by geography, what have we done? How have we done it? By sector, how have we done it? And so the only layer of difference between external and internal is basically there's no forecasting or guidance in terms of going forward. In the last 2 to 3 months, that is starting to change. Because of the downturn, what we're seeing, I want to flip back to kind of what we're seeing, we're starting to see that LPs are asking for a lot more transparency, especially around how you, the GP, is going to navigate this downturn. What's your strategy? How are you responding? How are your companies doing? How many do you think are going to graduate? How many do you think are going to follow on? They're asking some of these questions. And so to be able to have that data with you, it requires all these workflows to be built. I don't think it'll ever go to the point where LPs want a full-fledged forecasting model. I still don't think that should ever go outside of the fund's walls. But there are more questions coming up on what scenarios are you planning for, which I think might be a good segue into what we're seeing in the market. So I'm going to break this into 2 different buckets in terms of raising a fund and in terms of active funds. Obviously, none of this is probably surprising, but on the smaller end of things, so sub $100 million funds, it's an incredibly difficult market to raise a fund of that. What we've seen is if 10 months ago, if a GP was looking to raise a $60 or $70 million fund, now they're happy to be downsizing that to a $30 or $40 million fund. And the consequence of that is that the sub $50 million market is now incredibly crowded. So if you were already originally raising a $30 million fund, you're competing with a lot more GPs for that same pool of capital. In 2022, 83% of LP capital went to 7% of GPs. That's how skewed that curve is. So just so you know, that's basically what LPs are trying to do. They're trying to just over-index towards other established fund managers or where they don't see as much risk. Funny enough, though, even though that downsizing has happened, the velocity of new GPs has not slowed down. And I'll give you a data point here. Like a tactic, we get about 100 new funds that are modeled in the platform every month. These are new GPs coming in, building a new fund. That velocity has only gone up, if not stayed the same. So we're still seeing the same demand on the GP side. I don't think GPs are going away. We are seeing downsizing of commitments, but the number of GPs out there is still the same. So flip that back on the LP side, they're seeing the same number of people coming every month, but with smaller check sizes at times. So from an LP side, it becomes even more complicated and difficult for them to make the right decision on which GP to back. As it relates to portfolio construction, I'm hearing from my GPs that they get asked a lot more questions around defensibility. So again, your power law curve, why do you believe that to be the case? What your average returns are going to look like? Why is that the case? Just asking a few more level of questions than what they're typically used to. The big thing here, though, is, again, your model is not going to break your fundraise. Is your edge crystal clear in that construction plan that you're marketing, whether it's proprietary access to deal flow or a sector thesis. Again, that has to be front and center in your construction plan. On the active fund side, here's what we're seeing, and now this is across not just emerging managers, across our entire customer profile, as well as folks that we talk to. So these are billion-dollar funds as well. A lot of markdowns. We have seen that. We've seen that mostly in sector-specific funds, not so much in diversified funds, which obviously shouldn't be a surprise, but we have seen that. So Web3, crypto, massive markdowns on there, 50%, 80% markdowns at times. Having said that, fintech largely still okay, maybe 20% markdowns on there. And on a diversified pool, we don't think the pain has yet come there. Majority of our clients have not had markdowns yet. It's all been focused on a couple of sectors. Now, you can take that a couple of ways. Maybe the pain is yet to come. Maybe next quarter it might be worse, but that's what the data so far shows. So LPs haven't yet seen the write-downs yet so far. We have seen an increased activity of partial exits, and I think that's just locking up, converting your RVPI to your DPI. So just having more distributions if you can. So we're definitely seeing that conversion happen and locking in gains. Again, I think that's been specific to vintages of 2018, 19. So those funds have had enough of a horizon, enough of an RVPI that they can liquidate some of those investments. Liq prefs are making a comeback. I've had more people ask me about Liq prefs in the last month than all of the 12 months before that combined. And so I think we're starting to see that come back. It's still 1x Liq pref, hopefully not more than that, but we are definitely seeing that come back. Internally at the larger funds, we are seeing stronger, or I would say more stringent portfolio reviews. So I think everyone is going through an audit right now. And those audit processes are now becoming much more granular. People are going on an asset level, asking how much reserves do you have allocated? Is that the right company to allocate the reserve to? Should it go to another company? So that whole review process is becoming much more quant-driven. And I think I already shared with you that LPs are also asking for the same stuff. So I think it's more important now for funds to become, again, whether you use tactic or a spreadsheet, doesn't matter, but for you to have this workflow in there somewhere so you can answer these questions and insights really quickly. Cool. Those are all the major things I guess I wanted to cover. I'm happy to talk about recycling. I really put this as an appendix only because it's so confusing, and I'm happy to talk more about that.
I do want to go into recycling before we jump in. Are there any questions before I ask more questions? Anyone interested?
I had one question on, if I can chime in here, is on in terms of particularly for early stage smaller funds that you're seeing. There's obviously the main variables that are going to drive performance are entry valuation, exit multiple, and graduation rate. Are you seeing any commonalities in terms of like the ones that overperform tend to index on one of those three variables the most, or is it kind of even distribution?
Yeah, great question. I'll give you the answer. They over-index specifically on number of investments, portfolio size. They don't try and overthink on the reserves too much. The reserves, again, chips fall where they may. Let that drive based on the graduation rates. They're trying to solve mostly for how many deals can we do? How many shots on goal do we have? There are certain things you can control, certain things you can't control. Valuations, you can't control that. Even graduation rates, you can only somewhat control. But the one thing you can control is your entry ticket size and what that looks like. So they are very heavily focused on getting an initial foothold on target ownership and using that as a way to guide the rest of the model to try and get to 35 or 40 investments. And again, let the chips fall where they may in terms of reserves.
Thank you.
Since you brought up Liq prefs and that picking up. Oh, Alex, you can go ahead and ask.
Oh, sorry to interrupt, but
no, go for it.
So in my full-time role, I'm a product manager. So I'm thinking about, I'd love to learn more about how you think about potentially integrating with FP&A solutions deployed by portfolio companies. So then you can get more real-time data and check against how your forecast is playing out.
Great question. We do have a module in Tactic, a KPI manager where you can actually come in for any single company and you can track any financial metric or even qualitative metrics. So things like ARR, cash balance. You can track projections, actuals. You can request this data also from your portfolio companies. So you can actually send them a web form for them to fill it out. We are going to be releasing a Zapier integration this quarter, where it'll automatically sync up with whatever else is there in the Zapier ecosystem, whether it's Airtable, another FP&A platform, CRM, to kind of suck up that data automatically into Tactic. The goal here is to give you, the GP, all the insight on that deal in one single view. So when I click on company A, I see all the qualitative data around there. I see my round data around there. I see the KPIs that I'm tracking for it. So everything is in one place. So when you have to make a decision on what that next reserve looks like or what the scenario looks like, you're armed with everything on that.
Great. Thanks for showing that. Thank you.
There's the question. And then, when we talk about lick press becoming more prevalent in the market, is there a variable that you get to tweak in Tactic to account for that, or is that not a variable?
Yes, you can. So in Tactic, for any investment, and lick prefs can, of course, get extremely complicated. In Tactic, for any single investment, you can come in and define lick prefs. And basically, we ask you of how much lick pref you own, if it's participating or non-participating, if it's capped or uncapped, and then what else exists on the cap table. So what is senior to you, what's pari perceived to you, and what's junior to you. Based on that, we will automatically, calculate on the exit proceeds, apply that lick pref, and show you what that looks like.
That is incredibly intuitive. That's pretty easy. And then I guess from when you talk about power law and like there's more diversified funds that have a lot of checks on goal, but much smaller checks, like from a portfolio construction strategy and the different, comment types from like a very, concentrated portfolio, more the standard portfolio, like 30, 40 companies, and then the more kind of like smaller checks, lots of companies. What are you kind of seeing trend in terms of performance and interest from LPs?
I'm seeing, so great question again. And I think it's important to say LPs are very used to seeing standard models and try and fit to that standard model. If you're building a fund of 20 companies, you're going to have to do some explaining to do. I know you're at your early stage fund, you'll have to explain to LPs why you're deviating from the standard. So try and fit to the standard. But in terms of trends, what we're seeing is people want to do more reserves, but they don't have the capital for it. If you're a $50 million fund, you may not have enough capital to do the reserves while also trying to maintain your ownership. So we're seeing the trend of obviously SPVs and opportunities fund. And LPs totally understand that and get that. So most of the clients we work with on the pre-seed, seed stage, they're modeling not just one fund, but they're modeling two funds, a main fund and then an opportunities fund for their follow-ons. And yeah, I think that trend is going to continue going on.
I appreciate that. Are there any other questions on some of the topics that we've spoken about so far? I'll leave it open for about a second before we maybe go into the recycling topic, which I'm personally also very interested in.
Just one quick question on the reserve piece for smaller funds. I mean, our fund is like a $10 million fund. So are you seeing a lot of, there's one school of thought, which is like, keeping reserves to double down on, winners, if you will. And then there's another school of thought, which is just don't even do any reserves out of the fund and then just do SPVs opportunistically. Are you seeing any trends? Is that approach becoming more common?
Yeah. For a fund your size, I usually see folks landing in the second category. So there's no reserves on a $10 million fund. It's usually either SPVs or an opportunities fund. And the reason for that is with a $10 million fund, and if you're trying to solve for 35 investments, it's very difficult for your reserve ratio to fall into one of these categories that LPs are used to. You'll probably end up with a 15-20% reserve ratio. And that will require, you'd explain to an LPs why you're even doing that from this vehicle. So it's easier sometimes and cleaner to say we're going to do that out of this vehicle in an SPV.
Got it. Okay. Thanks for that context.
So a common theme I'm hearing is, don't try to differentiate on portfolio construction, differentiate in other ways because LPs are very familiar with these particular types of structures. And you're going to have to open up a whole other can of worms of explaining and defending yourself if you try to deviate from the norm on just portfolio construction in itself. Correct?
Absolutely. But innovation should not occur on the portfolio construction point. It should occur on other areas of your fund, your edge, your thesis. Again, this is a solved problem, and portfolio construction is just meant for you to follow a template, a standard. We have folks who kind of sometimes overcomplicate this because people try running Monte Carlo simulations and things like that. That can work if you are a large fund, you have a lot of reserves to deploy, and you want to run all of those simulations. If you're a sub $50 million fund, first-time manager, those are not where you should be spending your time. You should follow a template, stick to it, and concentrate on other areas.
Gotcha. No, that's good advice. Well, if anyone else has any questions, by all means jump in, but I would love to kind of go into the recycling topic.
This is where things get really nerdy, so I'm just fair warning.
Fantastic.
All right, so there's two types of recycling, and it's very important in your LPA to talk to your legal team on which type of recycling you're actually putting in. The most easiest one to follow is what we just call it straight exit proceed recycling. So an LPA is probably going to have a sentence that says the fund can invest up to 120%, 125% of its committed capital. It might have a subsection that says what is the most you can invest from a single proceed or a single exit event. That is really simple to follow. So what that means is in Tactic, I'll show you, we ask you those same two questions. So we'll ask you what percentage of your exit proceeds can be recycled each period. So if you have a $1 million exit event, how much can you recycle from that 1 million? Usually that answer is 100%. The second question is, what is the most you can recycle as a percentage of your committed capital? Usually this is between 20 and 30%. So that is what you set up here. And in this case, I have a $150 million fund. So we're saying we're going to try and recycle an additional 30 million of proceeds. But what's going to happen is if I set this up, as I said in an earlier point, the amount that we actually end up recycling may not always be 30 million. In this case, I'm actually able to do it. But sometimes that's not possible if you don't have enough exits occurring in that time frame. So that's the simplest one. That's exit recycling. Management fee recycling is a different concept where the confusion here, I'll say, is GP sometimes think I'm not going to get fees because my fees are going to go back in and into new investments. That's not true. You're still getting your fees. And the exits are still coming in and you're still recycling investments from those exits. The only difference is that you can only recycle up to a cap, and that cap is up to the level of fees that you've earned to date. So if you've earned 1 million in fees to date and you have a $5 million exit event, that means you can only recycle 1 million because that's the fees you've earned to date. And that is what management fee recycling is. So it's the same thing as exit recycling, except the cap is now based not on some percentage of your committed capital, but it's based on the fees you've earned to date.
That was not nearly as complicated as I thought it would be.
Okay, good. I'm glad. I've worked on and trying to simplify that. Things get complicated if you have both those provisions on, and I wouldn't recommend having that. But if you do have both those provisions on, then there needs to be a hierarchy. Which one are you recycling first? Given an option, most funds just do the straight exit proceed recycling. But management fee recycling is becoming a popular concept, and so I just want to make sure that was clear.
No, it makes perfect sense. And then, what kind of feedback do you see from LPs? I've heard mixed feelings on recycling from different LPs. So I'm curious what's been your experience and what you see from successful funds.
I mean, LPs like recycling. That's the blanket statement. But I think LPs recognize that most models that they see is recycling is too optimistic. They see stuff like this, that, hey, I am fully recycling all of my fees and expenses back to kind of get back to my committed capital. And they know this not to be true. They know this is not going to happen because 80% of the funds don't do this. So what they would rather see is something that's a lot more realistic in terms of what that recycling actually ends up being. And that is a function of your investment horizon. You have to clarify for your fund, are you allowed to recycle exit proceeds into just new investments or follow-on investments? Can you go beyond your initial investment horizon period? Like, all of those things need to be addressed. And sometimes that's not very clear in that upfront LPA.
Gotcha. This is, it's super informative, and also just the tool in itself just being so intuitive take what would be very complex and often probably frequently broken in Excel, when you hand it off to someone else. So this seems like a pretty good collaborative tool for teams. But again, want to open it up to anyone that might have any particular questions, either specific to tactic or portfolio construction, while we still have some time.
If I can ask one on, just to clarify that, when you say 80%, you're saying 80% don't do any recycling, or they don't meet what they said in their model?
They don't meet what they said in the model. They have some provision, but they don't achieve that.
Got it. Okay. Understand. Okay.
Gotcha.
Yeah, I mean, look, I'm always available. Tactic is at tactic.io. You're welcome to give it a free shot. There's a free demo there. You can build your fund. And if you'd like a more in-depth demo of the software, obviously just reach out to me. My email is right there. I'm happy to do a full demo for you. And there's a lot more industry trends as well. We'd be sharing that, with Thunder over the coming months as well. We try and publish that stuff out. So let us know if there's something specific you'd like us to double click on or give you some market data on. We'd be happy to try and find that.
Awesome.
Great. Thank you very much.
Awesome.
I appreciate everyone joining. But we'll hang out for another minute or so while you guys wrap up. We will have this recording published ideally by Monday, on Thunder, and we'll be able to watch the recording and some of the key highlights from this today. But you guys can hang out, ask questions if you'd like. We got a few minutes left. Otherwise, we'll start dropping off. Going once. Going twice. All right, I'll stop.
I can ask one. Let me ask. If anyone else has a question before I jump in, because I don't want to hog the airtime. Okay. So in terms of the, you mentioned the sort of, the portfolio size being, the portfolio size being a big determinant, like 35 to 40 being kind of a sweet spot for early stage stuff. In terms of like valuation, what I'm seeing in the real market is there's a huge dispersion at the pre-seed and seed. I'm in Web3 specifically. I don't know how true this is outside of Web3, but there's a huge dispersion in terms of like teams with, the same idea or concept can be sort of pre-traction and have a bit of product, and one team can be raising at an $8 million or $10 million valuation, and frankly, a better team could be raising at a high 20s. So it's a big or a $30 million valuation, right? So there's a big difference in terms of the valuation. It's team quality combined with how much they're trying to raise. So I'm trying to kind of thread that needle and kind of balance that. There's some that are they're so rich that I know this team's better. So I'm just curious in terms of how you're seeing, and obviously look, if all else equal, if you're paying double on average the entry price, that's going to have a huge, pull down of your term. So I don't know if you're seeing like ultimately that would translate into paying higher than the median price at entry, equal to or lower than the median price at entry. So I don't know if you've observed any trends on that in terms of
No, we have. I think I can generalize what you're saying in a much in sort of a different context, which is forgetting about Web3 or crypto. I might have two different type of deals, one of which has a better team and is much more expensive than another type of deal. And I might want to do both. I might want to just do both. How do I do that? So we see that a lot, and the way to think about it is different pools of capital with different graduation rates. The team that has, the pool of capital that has is higher price, maybe has a better team, maybe you have a higher diligence threshold on those, you should put a higher graduation rate on that sector. Create another sector, and then call it my general sector, and then my high growth sector. And the general sector, where maybe you don't have as much validation or conviction on that deal, that's a lower graduation rate. The whole point is to try and incorporate the higher risk on one of those investments somewhere in your model. Try not to blend those together into one median, because that's neither here nor there. And then you can create an allocation where you have two different allocations. You have a regular pre-seed allocation, and then you have my regular high conviction allocation. And in this one, you might be tagged to a different sector with a different graduation rate. So literally treating two different pools of capital with different graduation rates.
Got it. Thanks. I appreciate that context. Yeah, I don't know if anybody's done that. don't know if anybody's done that study. Obviously, there's a little bit of the mathematical thing where you're just saying like, look, this team is better. I know that they've had for these reasons, blah, blah, blah. And then it's sort of, you have to make an intuitive assessment to say, do I think that paying double on average the entry price is worth it because I have to believe the graduation rate is going to be double or more, you know?
Yes. And I will say here, Alexi, that I think the portfolio construction side of this is fairly mechanical and doable.
Yeah.
The challenging aspect of this is actually framing that as part of your broader pitch to LPs on why you're pursuing both of these strategies. And you might, be able to explain on why that is. Because those are obviously completely different methods, and your diligence process might be different as well. And so having to explain that's a different question altogether.
Yeah, got it. Thank you.
Cool. All right. Well, I think hopefully that was helpful. As always, just everyone here, feel free to reach out to me if you have any questions. And Jason, thank you so much for hosting us.
Yeah, no, great content. Really appreciate your insights, and hope everyone got some value out of today. And like I said, recording will be posted up, and we'll send out an email probably by Monday or Tuesday with that. And like you said, you have our contact information. I'll go ahead and pop mine into the this channel here as well as Slack, or not the chat there. So if you guys have any questions, feel free to reach out. Otherwise, maybe we'll see you guys around, and enjoy the rest of your day.
Wonderful. Thank you, everyone. Take care.
All right.
Bye.
Bye, y'all.